let's say a 30-year, 4% quarterly, $100 face value bond. What does that mean? Time to maturity, so N is 30 years. 4% is the coupon rate. This is quarterly coupon, so M is 4, and face value is 100. So how much will this bond be worth if the yield to maturity of this bond was 4%? So in other words, how much would we pay for this if we needed 4% return from this bond? Remember from the example when we were doing annual coupon bonds, there was a special thing happening when the yield to maturity matches the coupon rate. This bond is paying exactly the interest rate we want to get from it, we require from it. So we know you should be able to guess what the price of this one will be. It's a special price, but let's prove it, right? Let's use those formulas from the previous slide, the annuity shortcut, to figure out the price, and let's see if it captures that special case, right? So we can draw the timeline. You don't have to, but now this is quarterly. It's nice to show. So on the left top, we have the discount rate, which is the yield to maturity 4%. And then 1 quarter from today, so 0.25 years, we have the first coupon payment. Now, how much is each coupon payment? 4% of 100 is $4 per year. Quarterly means divide that by 4. 4 divided by 4, each coupon payment every quarter is $1. And there's going to be 30 times 4, 120 of these. And in 30 years, we're going to receive the last coupon payment and then the face value of 100. Okay. So now if we plug these in our annuity shortcut formula, each coupon, each cash flow, each coupon payment is $1, right? The $4 annual divided by 4, so that's 1. And then in the brackets, we have 1 over yield to maturity divided by M, 0.04 divided by 4, so on and so forth. And then, so that's the annuity formula. And then we have the present value of the $100, the face value, also divided by 1 plus YTM over M raised to N times M. And N times M is 30 times 4, 120. So let's actually do this calculation while we are at it. Good practice. So as always, I start with the annuity, and I start with the terms inside the brackets, and I start with the power term, right? So I start with I over M, here the yield to maturity over M. So this is going to be 0.04 divided by 4 that's our quarterly yield is 1%. I'm going to store this because we're going to have to use this a lot. Now I need to add 1 to this and raise it to N times M, which is 120. And then multiply this by, again, the 1%. So recall the number that I had stored, 0.01. And that's the denominator of the second term inside the brackets. 1 over X. So that's the second term inside the brackets. I store this STO2. I already have something in STO store 1, storage 1. So I go to the first term. That's 1 over the periodic yield, which is I recall my periodic yield, RCL1, take its reciprocal, minus recall 2, the second term, and that's the brackets, right? So now I need to multiply this by 1, which I don't need to. So this is going to be the present value of all the coupons, $69.70. So let me store this, STO2. All right, so now I need to go to the present value of the face value. In the denominator, I have 1 plus the periodic yield. So I recall my periodic yield, 1%, plus 1 raised to 120, reciprocal, multiply by 100. And that's the present value of the face value. So let me store that. So I have recall 2 plus recall 3 is the price, is the value of this bond. And it's exactly what we should get. So we are on the right track. Right, 69.7 plus 30.3, 100. Remember again, very important rule that if the bond's coupon rate equals its yield to maturity, it's already paying enough interest to satisfy the required returns of the bondholders. So it's going to trade at its face value, no more, no less. So we call this, it's trading at par, or it's trading at face value, right? So we didn't even have to crunch the numbers. So whenever you see, if you see any bond, any coupon bond with the same coupon rate as its yield to maturity, price equals face value. That's that. All right. But what if now, let's say the yield to maturity changes. So something changes and the market, which is collective wisdom of all the bondholders, investors looking at this bond, collectively decides that we don't need 4% from this anymore. We would be okay with 3%. Maybe interest rates dropped in the economy. Maybe this bond got safer somehow. For whatever reason, we are going to be satisfied with a lower return from holding this bond. So 3%. But it's paying 4%, right? It's paying too much. So something's got to give, right? And of course, what's going to give is the price. The price will have to move, right? In what way? So that's important, right? If the yield drops, what does that do to the price of the bond? Remember, I had already mentioned this inverse relationship between yields and prices, right? So we should hope to see, and this is a good way to check whether you are doing the math correctly, yield that's lower than coupon rate should give us a higher price than face value, which we call a premium, right? This will be a premium bond. Or in general, you look at the price. If the yields drop from that price, the price should go up. Why? Because at that new yield, low yield, this is a really, really valuable bond, right? You will not, if you own this bond, you're not going to want to sell it easily. You're going to ask for a premium, right? Because it's paying too much interest. So this is really good. So we're going to value it highly. So let's see if the math works like that. So we have the same, of course, timeline, but the top left, the yield is different, now 3%, but same coupon amounts. So we plug everything in exactly as before, except the yield, instead of 0.04, it's now 0.03. And then crunch the numbers like we did before with just a slightly different yield to maturity. And not too surprisingly, we find that this is a premium bond. It should trade at a premium to its face value, and a considerable premium to its face value of almost $120. So by the way, later on, this will be important. We're going to talk a lot about this, that if yields change, so if interest rates in the economy, for example, change, right, prices of bonds move in the opposite direction. Right? By how much? Right? The yield dropped 1 percentage point. How much did the price go up? And it's even more important when yields go up, prices drop. That's very bad for bondholders. That's a big interest rate risk. So if yields go up, if the interest rates go up, yields go up, how much will the price of the bonds that I hold in my portfolio, how much will they drop? How much do I stand to lose? Right? Some bonds will drop much more than others. So they will have different amounts of interest rate risk. And that's going to be something very important for us to compute later.